Welcome to the Asset Revolution podcast, where each week your hosts from Arbor Digital provide educational opportunities for financial advisors and individual investors to gain knowledge in this emerging powerhouse that is digital asset investing. The Asset Revolution podcast is your connection to the future of digital assets and an opportunity for anyone to get off zero. Let's dive in. Welcome back to the newest edition of the Asset Revolution podcast. I'm excited. We have Matthew Kolesky, principal of Arbor Capital and co-founder of Arbor Digital, back on the podcast. And today's episode, we are going to be diving into actually a continuation of a recent webinar we did in partnership with Digital Asset Research, which is one of the research firms who we partner with to stay on top of digital assets and the industry as a whole. But before we get into that continuation of the recent webinar where we did a deep dive into what's ahead for crypto in 2023, Matt, welcome back to the podcast. Thanks for being here.
Yeah, Mark, thanks for having me back. Yeah, we had so many things we wanted to talk about. We didn't get to all of them. So we're going to kind of get into some additional topics as we finish up 2022 and look ahead for the year we're almost a month into it already, but let's go.
Yeah, I was going to say, it's been actually a pretty eventful first few weeks. We are recording this on January 25th. Both good. I, again, don't want to say bad. I feel like everything is good, and that's just my optimist side coming out. But I think where I'd like to start is this idea of we have this mantra here, and that's something that you've said in other places. It's called boring is beautiful. And while maybe in 2021 and 2020 and early 2022, maybe that wasn't something that people really like to hear. But as we went through 2022, I think that started resonating more. And it wasn't that boring is beautiful. It was kind of what that really meant. So Matt, I'd like you to kick this off with what does it mean that boring is beautiful? Why do we tell people that?
Yeah, it's a good question. In this asset class, and we've seen a lot of it really come home to roost in 2022. There's this idea of just these hype people and these pitches, and it's all this head in the clouds and everything's going to be fantastic. Just you need to put some money on this platform and everything's going to be great. And that's not what blockchain technology is about, right? And so when we say boring is beautiful, we have these ideas of head down, we're building, ignore the hype, and just carry on with building new technology platforms, investing in them and engaging with them in new ways. And that's what's really exciting. So companies take out Super Bowl ads and they spend a lot of money on PR and marketing. And, to some effect, I get it, they're trying to bootstrap network effects, but, when you have, unethical people behind it, it makes it really difficult. And we talked a little bit about this on the last podcast, right? We have to separate that hype and all that other stuff from the actual technology. So boring is beautiful. The Bitcoin is beautiful, right? Ethereum is beautiful at the protocol fundamental levels, what they're doing, right? There's 10 minutes, another block, right? It's like, it's still doing its thing regardless of all this hype and all this noise that continues to happen on top of it. And we can get into it a little bit too, like what are the use cases? And we'll talk a little bit more about that, but just focus on what's working, ignore the garbage that's out there. And so that's to me what boring is beautiful means to me and to what we talk about here at Arbor Digital.
Yeah, and I appreciate you diving into more kind of what that means. And I think for everyone, I think when they hear certain things, it means different things. So I think another element to boring is beautiful is that, we are these traditional finance people with traditional backgrounds coming into this extremely new space. And, you hear the narratives that people want to say the wild, wild west. And I think when we brought in kind of our mindsets, we see the opportunity, but then when we start talking about things like risk management or, sizing positions properly to have, risk-weighted approach to investing in a multi-asset portfolio, within this space. And even, just talking to people about having just an allocation of Bitcoin and ETH. And, although that may seem boring, sometimes that's the best way to start investing. And I think people would be surprised because, and this happens in traditional media as well, in traditional asset classes. I think in the age of social media, and especially with crypto, hyperbole and extreme statements and going all the way to the extreme, like saying, this is the best, or this is the number one. And the funny thing is every single, tens and 20s and hundreds of people and platforms and businesses are saying we are and the funny thing is there can only be one the best if we're thinking logically about this. So not everything is the best. And I think when we would approach, and we would be kind of boring, we would say, yeah, I mean, we would just kind of be realistic about who we are, where we're at in the industry. Nobody's the best. Everyone's just trying to figure it out. Everyone is building. And the reason why you would go or hire someone like us or others in the industry is really boils down to process and the people behind it. Because no one's the best right now. Nothing is the best. And that's the reality of where we're at. But I think being honest about that, and I think that's where boring is beautiful to me. And we're not going to be those hype people.
And Marc, you say it's nothing, nobody's the best, nothing's the best, because we're still so early, right? What the use cases of what these protocols can be and how we interact with them is still being discovered, right? There's new use cases coming out all the time. And so, one might take the lead over another, and then the other one kind of catches up. And so that's why it's important. You talked about how we view this, right? What is our responsibility to our clients is to have this thoughtful, balanced approach to these assets and stay grounded. It's really important to have that kind of a mindset.
Yeah, absolutely. Well, I think that let's use that to dovetail then into kind of what's happening, aside from price and what everyone wants to, be extremist about. Let's talk a little bit about kind of those things. So I think the two biggest things right now that are coming to light that everyone wants to latch onto is AI and tokenization, ChatGPT. And now everyone and their mother all of a sudden is talking about tokenization. And I think we mentioned this on the webinar. We dove a little bit into it, but I want to dive into this a little bit more because I think it's important because, again, separating the hype machine from what's really happening. Take us through, because tokenization was something you talked a lot about even back in like 2019 and 2020 when you guys were initially building out Arbor Digital and thinking about what the investment thesis was. So take us through kind of the history of tokenization and kind of what your thought process has been and how you've been bringing that forward.
Yeah, that's a good point. And one of the things that we mentioned on the last one was, getting real world assets on chain, right? And kind of tokenizing them so they can be traded on these new rails. I think that is, to me, like the holy grail. But yeah, going through the process of it, right? And there's been paying attention to how these protocols have interacted with real world assets, from real estate to fixed income, right? There's Societe Generale and MakerDAO have actually entered into agreements, and they're testing using the MakerDAO rails for some of their bonds. And so that to me is really cool. So what they're doing is they're making a deposit into the MakerDAO, they're issuing DAI off of a secure tokenized asset. And so that to me is, kind of the future and the holy grail of this. So if we can get stocks and bonds and real estate and use these new protocols to replace the traditional financial system, that's kind of the dream. So, and then what's important about that is you get real cash flow, right? You can get real cash flow flowing into these things instead of, oh, we've got 10 billion tokens and we're going to pay you with more tokens. That's not yield. That's not anything but just, Ponzi's and things like that. If you can actually have real value that's flowing through the blockchains, and some of that can be from the protocol itself, I'm not discounting that. But if it's all just extra tokens that people are minting, then that really doesn't have a lot of value. And so when I think of tokenization, it's like, how can we take these assets, create a structure around them, with this new financial rails to create value and to create new ways for people to interact with them. You had a great post the other day, Marc, on LinkedIn about, the future of financial services that was talking about using wallet technology instead of, I've got my bank account, I've got my 401k, I've got this, I've got 18 different relationships. It's all coming through one or two central wallets with these assets that are now tokenized. Like that's what's really cool. And what I think the future's going to be in store for us. It's going to take a lot of regulatory movement for that to happen, which we can talk about.
Yeah, and I think one of the important things that I think gets misunderstood or lost in translation when it comes to, you know, what people actually report on, and there are some really good reporters. Levine over at Bloomberg, he does really good deep dives, and he talks a lot. And he was an original crypto skeptic, and now he does a really good job. But I think, you know, and especially in relation to that post, I think what you're going to see is a melding. I think you're not going to see, you know, tokenization of everything and then these new decentralized networks who have their native tokens that, you know, have a purpose and are actually solving for something. I think that's one of the problems that will be solved. It's like the tokenization the tokenization of real world assets, and then having these new assets all working together. And that's and we mentioned the Holy Grail. The combination of the two is actually what's going to be unlocks this whole new industry that we're talking about. And I think Adam Bloomberg talks us loud, you know, like, you know, 7 to 10 years from now, we're not even going to call it DeFi. It's just going to be, you know, regular fi. Like it's just called finance. And that's what kind of what our purpose is, you know, we know not one thing is going to take over the other. We know there's going to be this symbiotic relationship between the two based on, you know, the technology, based on how we see the use cases evolving. And so I guess that's kind of where we're at. And that's why, you know, because people will ask, you know, well, if they're just going to tokenize real world assets, why am I not investing in BlackRock's tokenized platform then? Why don't I just invest in BlackRock as opposed to investing in something like a Uniswap or a decentralized network?
You bring up a very good point, Mark. And I think this is going to be this battle of these traditional Wall Street and traditional firms running permissioned, you know, private blockchains to do settlement, which is going to be far more efficient than what they're currently doing. But that's still, they're going to control the gates, they're going to control the access, right? And that's one of the kind of criticisms of traditional Wall Street. You know, it's done a lot of good for sure, don't get me wrong, but we want to increase accessibility, increase the different ways that people can have access to their money, as well as, you know, all these new potential things that they can do with it with this new technology. So the battle that I see happening is between this permissioned ecosystem versus the fully decentralized. You know, you talk about Uniswap and these other protocols where anybody can access them. And that's where the regulators, I think, are going to need to come in and help out and help kind of settle this, or hopefully not just grant all the access and power to the traditional firms that are building permission private blockchains. That's, I don't think, the end game that anybody that's building and working in this space wants to see. But if you listen to people like Jamie Dimon and these other people, that's what they want. And that's what they're advocating for. And that's why you see them talk not necessarily in great terms about all the public block. And to be fair, there's a lot of reasons to be critical of, you know, the Wild West that we saw in 2022. But again, that's not the protocols themselves.
Yeah, and I guess let's just take the moment here. I know, even though we say it so often, what happened last year was not crypto. Like, was not the technology. It was not the software. Like, actually, the technology and the software did exactly what it was supposed to do. Everything worked great. Like, if we look back to 2022 and we got rid of the bad actors and we didn't, and no fraud, we would be able to focus on the technology and what actually happened. You know, the Ethereum upgrade, huge, massive undertaking. Like, we talk about Bitcoin Day and the first mining of the block. Like, that's going to be another one of those days when we look back 5 years from now, that, you know, when the merge happened, like that, such a significant, and it all was just overshadowed by the non-crypto, the things that happened to crypto, not the things that happened in crypto.
And yeah, Mark, that was some of the things that we wanted to get to, right? The headline events from 2022 that contributed significantly to volatility. It overshadows a lot of what we're talking about. It completely did. And it even the work that, you know, DAR, Digital Asset Research, doing the work that we're doing, it's like we're tracking all of these things, the wallet and all the metrics and things like that. But then you have these other events that just kind of overshadow all of that. And so one of the things that we're trying to do is and we're asking the regulators let's create a framework and a structure so we can remove these bad actors that just add to the volatility that's unnecessary, right? It's like looking at kind of what happens in the traditional world with the GameStops and things like that. Like, yes, it can happen in the traditional world. It doesn't happen nearly as often as it does on the digital side. And we need to put some parameters in place whether that's self-regulated, which there's people working on that, or if the regulators are going to come in and do it themselves, because we need to remove that. There's a lot of good work being done. And there's a lot of promise for this technology, and that's the focus.
So what do you see? Tell us about some of that good work that you've mentioned a few times.
Yeah, you look at the smart contracts, I'm not going to, well, whether we're talking about Ethereum or some of these other protocols building on top of Ethereum, just think of the potential right now. I already talked about one where the people are using the protocols to bring in real world assets and issuing loans that are fully auditable and transparent, right? You can see what this loan is, and you can see where the triggers are for it to be liquidated, right? Very clear, very transparent. That is really exciting. And then if you think about how you can take a smart contract and say, here's this particular loan or this particular financial instrument, here's all of the details that you need to see, right? And here's the triggering events. And so it makes auditing and it makes regulation actually so much easier. It can be done with smart contracts. It can be done and automated away, right? So you talk about this abstract idea of automating away a lot of this kind of manual things that can be done with smart contracts. That to me is the beauty of it. And when you think about the transparency, you can make transparent and clear what needs to be transparent and clear. And then if there are some private things that need to be private, because I get there's intellectual property, you can shield that with ZK, some of these zero knowledge proofs and scripts that are being put into these smart contracts. That is really exciting to me, right? And then you can say, okay, if maybe the market doesn't need to see this piece of information, but the regulators do, and the regulators can access the smart contract through their own platform to validate what they need to validate. That to me is what really gets exciting, but I don't see that happening yet. That's probably like 3 to 5 years down the road. But when you think about how technology can make things, whether it's more efficient and transparent from the regulator side, as well as just from the fundamental financial instrument side and how people interact, that's what gets me excited.
Mm-hmm. And you mentioned a lot of the regulatory landscape already too. So I'd like to linger there for a little bit because, as Chief Compliance Officer of Arbor Capital and, of Arbor Digital, you have been involved with many things, some including the SEC, working groups. So tell us a little bit deeper, because especially on the webinar, we had to rush through a little bit because we were running out of time.
Yeah.
Take us through what you see happening, and I think there's two things I like to do is one is how does regulation happen? And then two, does that lead to consolidation in the space?
How does regulation happen? So there's a lot of groups now that have popped up in the last 3 to 4 years that are being advocates for blockchain, and we'll call this lobbying, right? Because that's essentially what it is. But these are groups that go to DC or based in DC and help steer and drive the conversation and really educate the folks in DC about what this technology is. And we saw that, what was it, a year or two ago, where there's that bill that was put in and people were like, no, the crypto people was really loud about it. And so you've got to take some of these things out because you're really just going to absolutely punish. It still made it through. It doesn't go into effect, I think, until 2025. In fact, but that's how the regulation is going to get done. We need advocates in DC championing these and educating the policymakers about what this is. And so I'll use an example of this. When we still see politicians kind of confusing what happened in 22 with the technology, and there are a lot of prominent politicians still just kind of attacking blockchain technology at its core. And even I'm not sure where they're getting their numbers talking about, how it doesn't provide access and people are getting burned and scammed and all that good stuff. So that to me is a battle that we need to champion. And we're involved with some of the groups that you mentioned. We've talked about Planner DAO and some of these other groups that we get involved with. In terms of the SEC, you talked about, I've had some calls with them. They're listening. I'll put it that way. There are people now. We all know what the top down is, what Gary Gensler's doing, and how he's approaching things. But there are other people within the SEC that are listening and paying attention, and they do want to be technologically agnostic, right? They don't want TradFi. At least they're saying this. They don't want TradFi to win. They don't want DeFi to win. They want to be agnostic and just create the framework. We haven't necessarily seen that yet, though. So they seem to be still in listening mode. The other thing I'll say is I'm not going to get super, I don't want to get political or anything, but when you start to see CBDCs come into the discussion, which is, I think, a way for central banks to distribute their own currency, that is not blockchain technology. That is just governments taking their own currency and trying to put it on rails and make it faster and easier for them to distribute. So I just want to make a note about that.
Yeah, and I guess you've mentioned this a lot, even when we think about the Howey test, right? How that came to be, that came through the court system, and that didn't come through proactive regulation. So I know you mentioned the SEC and how we need this representation in DC, but I guess you've talked a lot about this too, that you think a lot of the regulation that will come to digital assets is actually going to come through the court system and a lot of these enforcement actions. So tell us a little bit about that and what you're seeing specifically.
Well, I'm hopeful that the SEC can come or Congress together can come and create some policies, but I don't think that's going to be the path, right? And so, as you mentioned, and as we've talked about before on the podcast, the Howey test was settled in the courts, and so that is still the 4-part test to determine what is a security that the SEC still uses and stands on. Unfortunately, we talked about this on the last time, right? This new lawsuit against Gemini and Genesis around their lending product, what the SEC saying that was a security, that has nothing to do with crypto. That's a lending product between two entities as well as an individual. That's not crypto. So my point is, right now, there's nothing in the courts that I'm aware of that could potentially settle once and for all what is, are these things securities? Are they commodities? Are some of them different? And I think we've talked about this before. Hester Peirce, who's one of the commissioners, she has talked about kind of creating this framework, a safe harbor for a couple of years for protocols to become sufficiently decentralized, so it can avoid them, potentially passing the Howey test and becoming deemed a security, right? If they're given sufficient time to fully decentralize from their launch, that's a new innovative way that some people within the SEC and regulatory bodies are looking to approach this, but that hasn't gotten a lot of traction, unfortunately, yet.
Yeah, and I think another similar case that I think we will get more clarity on, but I don't think actually brings us closer to the true regulation that will unlock kind of some of the potential that we all see, is kind of Grayscale versus the SEC. Last year, Grayscale went on the offense, and they want to churn GBTC into an ETF, and they're basically suing the SEC as to the reasoning why they declined their application and kind of why they haven't done that, and saying how much good it would do for everyday investors,
right,
if that were to happen. But that doesn't push us forward on the decentralized blockchain or decentralized crypto asset spaces.
It doesn't. I will say, one of the reasons, and the SEC denies, there's been a dozen at least of people that have applied for a Bitcoin ETF. One of the main reasons the SEC says is a lot of the price controls are outside of the United States, right? They're taking place in these crazy markets in Russia or in Singapore, where they have no control over it, and it can be subject to manipulation. And that's not, that's a pretty valid point. And so when you see,
I was going to say, if anything that's been proven for 2022,
right, and so they've been
proven pretty correct on GBTC specifically as well.
That's a valid criticism. So when you say, well, then how can they launch these futures products, right? Well, the CME group, right, has launched, I think, for 6 years now. They have a Bitcoin futures contract that they are tracking, and they trade within the US, and they launched an Ethereum one about 3 years ago. My point is, we're starting to build this framework internally within the United States to actually have better price discovery mechanisms and better kind of base layers of reporting to build on top of that the SEC would be more comfortable with. So it is happening. It's happening slowly. And again, we should, full disclosure, Arbor Capital owns, we shareholders in the CME group in terms of it's in our client portfolio. I just wanted to put that out there. But so, yeah, very valid reasons why there has not been a Bitcoin ETF approved, and why there has been a futures Bitcoin ETF approved in the country. But when you start to think about why, it does make a little bit of sense. But that gets to the point of the need for international regulatory harmonization, right? Because these markets are unlike anything any of these regulators have seen. They trade 24/7, 365. They exist, on the internet, right? And so that's a game changer. It's not, oh, we got a bunch of servers sitting in New York or Chicago or wherever these, markets may be. They're global. They're nonstop.
Yeah, and I think a couple of things that get lost is that, while we have a lot of home bias, it is important to make sure that we realize all of the regulatory work that's happening outside of the US. So, Doug Schwenk, who was on the webinar, mentioned MICA. And I know there's a ton of has been happening around in the African nations. Asia has been a lot of the innovation that has been able to happen has happened in Asia, but there's also been some troubles due to that lower level of barriers, I guess you should say, to the industry to innovate. But talk a little bit more about where you see regulation of actual crypto and decentralized blockchain networks and their attributed assets. So again, Ethereum network versus the Ethereum asset. Where does regulation of those things come from? Are there any court cases or anything that you're seeing that leads us further down those paths?
There's the Ripple case that's still pending, and I think we're going to get probably some announcements in the first half of this year, which could clarify and probably raise more questions. Is probably what I'm expecting. Marc, you mentioned something earlier, and I think it's something you talk about where you see a lot of adoption in places that don't have a stable currency, or they can't trust the government to run the currency, right? So that's really important. We definitely have this Western and this U.S. bias, and it's hard to break through that and think about it from other people's perspectives. But in terms of the cases, I think the Ripple SEC one will be interesting to watch how that came about. We could get some movement, like I said, in terms of, is it a security? What does that mean for Bitcoin, for Ethereum, and for these other ERC20 and other types of tokens that are being built on top of Ethereum? But I don't, in terms of, is there anything right now specifically naming Ethereum and Bitcoin in a court? Not that I'm aware of, that's going to give us any regulatory clarity.
And I think, again, I think one thing we are we want more regulation. I think everyone who, when we tell people, where we specialize, I think they think we have some sort of view that is more, I guess, crypto bro-y or more crypto evangelical. But we want the regulation. So especially if it continues to flush out the bad actors, because it just completely overshadows all of the good that's happening. We need that. So do you see regulators on a global scale punishing more of the bad actors? Do you see them going after those kind of hype people? Again, Kim Kardashian was a big thing, that got a lot of headlines, these cult-like followings that are raised. Do you see anything else happening there before we move on to, kind of the consolidation piece?
Yeah, I think the bad actors are going to be punished and should be for what they were trying to do, right? Run Ponzi schemes and just take people's money and buy nice houses for themselves and donate to political people, and just, it's insane. Yeah, that all needs to go away. So it'll be interesting to watch I think I watched the Super Bowl ad. I watched the Super Bowl halftime show and some of the ads. Last year was all crypto. It'll be interesting to see what the ads are like this year. But to your point, Marc, the Kardashians, the folks that, Matt Damon and Larry David, all these people that were on the Tom Brady, right? All these people that were paid significant amounts of money to be spokespeople for these, what now is, quite clearly, either straight up fraud or a Ponzi scheme, is not good. But they should be punished. Not saying those individuals necessarily, but the people that were running those exchanges should be. There's also a big one out there, right? There's a big one out there that is outside the US, and it's Binance. And that's still kind of hanging out there. I don't know, how people are thinking about it, but in this country, but it feels and smells and looks a lot like some of the things that have blown up in 2022.
Which means we still have to be careful. And I think, and one thing that I get one of my pet peeves, one of the questions I ask everyone on the podcast now is what's a pet peeve of crypto? And one of my biggest pet peeves in crypto, and this is everybody, even the quote unquote smart people who are doing great things, just we tend to focus so much on price, especially when the prices are doing relatively better than everything else. And the start to this year is a prime example. And I just wish we could start conditioning, people to do what, and then those same people who post about the price so here's the example. Sorry, I'm going theoretical. I'm going to go straight into a specific example. Here's what we're seeing right now. In the first 3 weeks, digital assets, so let's say Bitcoin, Ethereum, have run up between 30 and 35% to start off the year. And so I've seen so many posts from, again, influencers, people who are trusted, I guess you would say, publicly in this space, or like that have the loudest voices. And every single post is now saying, oh, this is the value. Like, look at the price. The price went up. See, look at the price. And every time I see a post like that, I'm just like, stop it. Please stop. Because that is not important right now. There's a reason why private equity is private equity. And there's a reason why retail investors haven't had access to private equity. And one of the benefits of not just nilly-willy having access to private equity is because private equity would go through these types of things where you would see, if you were to have price discovery on them, you would have these exponential moves in either direction. And the reason why that retail investors don't, because retail investors are emotional. Like, everyday people aren't meant to sit there and track these things where price actually doesn't matter right now. We're so early, and we're conditioning people to attribute the value of what's happening to the price. And that's the conditioning we need to change. And that's our responsibility. It's everyone in the space. So if you're listening to this right now and you're in crypto, or you want to try to influence people to adopt crypto, or to go be more intellectually curious about the space, stop posting about price. And especially stop posting about prices saying how much better it's doing relative to stocks or bonds or anything like that. Because when you condition people to only focus on price, guess what's going to happen whenever things go wrong or don't go your way? What's the first thing people are going to focus on? It's price. And then now you have to try to overcome all of that. And now when they think of the value. And so we have to do a better job of helping people attribute what's important to these spaces, like wallets, transactions, adoption metrics, like network effects, all the different cited markets that come with network effects, and how you measure all of those. Just so many different things that matter more than just the price. Sorry, I just went on a little tangent. I'm done with my tangent. I'd like to move to consolidation in the space, because I know you have some really good thoughts around consolidation in space. What do you think about when you think about consolidation in crypto or digital assets, TradFi, in 2023?
Yeah, I think there's gonna be some consolidation. We've seen big layoffs from some of the big, not just the big tech firms, but even some of the big CeFi crypto exchanges, right? Coinbase and Gemini. And you've seen, and I think we're going to continue to see some downward pressure on these companies as we continue to roll into 2023. And when I think about consolidation, I think about, as traditional financial institutions are looking to enter the space, they might be able to, consolidate with one of these other entities, right? You've got, Schwab and Fidelity and, Goldman and JP Morgan and all these big firms out there that have various degrees of an exposure to digital assets, right? Fidelity is probably the farthest down the road. But if somebody wants to jump ahead and get access, yeah, they can either, look at these other companies potentially, or, go, if they really want to be creative, right? Go and integrate with some of these wallets. Go and start interacting with these DeFi protocols. And you're starting to see this, right? You've got Aave and Compound and where they're starting to create these kind of permissioned, I'll call them almost like not side chains, but they're like a clone of their current chain, where they're running some permission protocols for some of these institutions. I don't know how I feel about that, but it is what it is. It is ways for the traditional institutions to at least get exposure and get their fingers into and see and experiment with these protocols. But that's what I think about consolidation. We've talked a lot about this internally, like what does the events of 2022 mean for the Coinbases and the Geminis and Crack and all these other companies, BitGo, there's probably gonna be consolidation because there's probably too many firms out there right now.
Yeah, and I think
you've got the crypto.com, you go down the list, right, of the people that were spending hundreds of millions of dollars to sponsor arenas and do all this other stuff.
Well, and this is where we like to educate people too, because I think they all get lumped in together, and I think that's a mistake, and I think that's a mishap on our part. We don't define or do a good job, and we try to do a good job. It doesn't mean we do a good job, but we wrote an article, explaining the difference between DeFi, TradFi, CeFi, and then CeFi or TradFi, CeFi, DeFi when you combine them, not when they're separate. So we wrote an article, and it's on our website. I highly recommend you go check it out. We try to demystify kind of these separate types of industries that are all kind of had this underlying base of crypto. And so what I think we're seeing is we have these centralized traditional finance firms that have been created, and where the back end is they are looking to pipe into the new rails, and they're it's that first stage, if you will, where they're not completely new rails of the crypto or the DeFi space, but you have these centralized entities. So Coinbase is an example of a centralized, and so we call them CeFi DeFi, centralized finance going into DeFi. And that's what Genesis is. That's what Genesis was, I should say. Now that they are, well, actually, I shouldn't say was, who knows, but they may come back. Who knows how that's going to all play out. But I think this is an important place where we can educate. And I think, especially when I think of consolidation, I think where you're going to see the most consolidation is in the centralized, the CeFi, TradFi space, which is basically traditional finance, methodologies that are just basically being carbon copied onto this new asset class to take advantage and to do things, which is fine, which is great. I think there's going to be this melding of the two. And they're going to interact with each other, and they're all going to work together to build the industry up. Again, the eternal optimist in me, that's the way we see it playing out. But I think that's where the most consolidation is. You see all of these exchanges, Coinbase, Gemini, Kraken, crypto.com, FTX. We have all these different people all solving the same problem. And we know that not all of them are going to survive and going to exist. And I think you're going to see further consolidation there. And then where I think we're going to see consolidation is in the TradFi traditional finance. So you have your traditional finance players, you mentioned their names, Schwab, Fidelity, BlackRock, BNY Mellon, one of the oldest banks in the world, is heavily involved in, their Bitcoin mainly, right, with some Ethereum adoption, but they're chomping at the bit. They see that they can maybe go scoop up some of these centralized entities that more have a crypto native background, and crypto native, they're trying to pipe into the crypto native infrastructure to where now they can come in and get 10 cents on the dollar, maybe even less. I think you're going to see that there. And then I think in the crypto space, in the purely decentralized finance space, there is no consolidation. It just goes to zero, and then everything naturally gravitates towards where things are working, where actual problems are being solved, and where hype trains just aren't, where Bootstrap isn't just you get 3 anchors where people are going to deposit and create this token out of thin air and then go start manipulating it across different exchanges. And then you sit and that masks itself as network growth. And then you try to get more people to go there. All of those things are gone. Consolidation means those go to zero, and the platforms and the networks that are doing things and building the right way, that's actually utilizing technology, those are going to survive. And that's the way I see things playing out. But I'd love to get your thoughts there.
Well, I would just say these protocols that have been battle tested and have been around. And I think, Mark, what you're what you're talking about is how to value these networks and the Lindy effect, right? And these are things that we take to heart when we talk about our internal investment thesis. if it's been around for 5 years and it's still functioning, it has a lot more value than something that was launched a week or a year ago that has never been battle tested. And you're starting to see, this is my opinion here, I'm going to opine a little bit, that these protocols that have been built, whether they're running on Ethereum or, they've been around for a while now, and people are getting used to it. Because we talked about trust before. It's like, what does trust mean? It means that you're used to doing something over and over. Like if I go a year later and pull up my MetaMask account, I want to interact with this protocol, I know that it's still going to be there, and the contract that I locked my assets into are still going to be there, even if I haven't done anything with it for a year, right? That is what trust is. And so these protocols that have been around for a long time, some of them 5 years now, and they're battle tested, their code has been audited and been tested, and you can see the attack vectors coming, and they've pretty much squashed all of them. Like that is where I see tremendous value. And I just want to say another thing on that front, in terms of narratives and network effects. And this is something I see traditional analysts, traditional people like still struggle with. And it is how to value and understand network effects, because it's not easy, right? But I always go back and use Amazon as an example. 20 years ago, Bezos was literally saying, I'm building a network. I don't care about profitability. I don't care about cash flow. I'm building for 10 or 20 years. He's building a network. He's building a company that is going to have exponential growth down the road. And if you're always backwards looking at cash flow, you're going to miss it. And it's the same thing with some of these protocols and what these use cases are going to be developing. If we're just backward looking and not looking to the future of what this technology can become, we're going to miss it. And the other point on that is this narrative adoption. You see people trying to grab the narrative, and I'll pick on Paul Tudor Jones, which was a great article that was almost 2 years ago or 3 years ago now that he wrote this, around what is Bitcoin's narrative. And he was trying to equate it to this digital gold, this inflation hedge, and which is great. That's just one potential narrative for Bitcoin, right? And people can argue whether that worked or not. And I always say, well, go look at the 10-year price of gold and tell me if that's been an inflation hedge. But shorter term, people can cherry pick the data. My point is, you've got Bitcoin, which I will still argue is the most secure network in the world. What value does that have, right? To me, that is tremendous. If you can build a network that now has a settlement layer baked in, which is what Bitcoin does, there's there's protocols and there's projects that are EVM compatible that are settling onto Bitcoin. I think that's really interesting. It's called RSK. Like that is using the best of what I view Bitcoin is a security and settlement layer with the smart contract and functionality of Ethereum, like in one. And I know there's risks with bridging and things like that, but that to me is really exciting. My whole point is like, let's shift the narrative away from, oh, it's gold or an inflation hedge, to this is a secure network with programmable smart contracts, programmable money, and let's reimagine what finance can be. And we've talked with our good friend Steve Larson, right? He's talking about these streaming payments. Like, imagine if your paycheck was streaming to you constantly instead of you getting it twice a month or once a month, or your dividend payments are coming to you streaming, right? Where if you own Coca-Cola, right, instead of getting it every 4 times a year, it's streaming into your account constantly. That's one of the use cases of some of these smart contracts. That is really cool, and that completely changes, right, the idea of what some of these financial systems do.
Yeah, and I love that you use the Amazon example, because even just to take that a step further, upon doing my own studying of Amazon and kind of the history of there, and when Jeff Bezos was out there trying to get investors, he told investors, I'm going to lose money on purpose for 10 years.
Yep.
And he's like, you're going to invest in me, and then, oh, by the way, like I'm going to lose money for 10 years.
Right.
And then I remember hearing there's a capital allocator who I was listening to a podcast, and he talked about, and this is not even a crypto podcast, this is just a traditional podcast. And he talks about, some of his best investments, and one of the best investments he made was in Amazon. And he talked about his experience of sitting in a conference where who's Charlie Munger? Wow. Buffett, thank you. Wow. See, that's my brain working right there. Wow. I can remember Charlie, but not Warren. So he talked about how there was a conference where Jeff Bezos was on the stage talking about Amazon and his vision and everything. And then Warren Buffett was on. And thinking about when Warren Buffett came on after Jeff Bezos had talked, Warren Buffett was like, that's a really smart kid and he's really talented, but I will never invest $1. He just told you he's going to lose you money for the first 10 years.
Right.
I would never invest in anything like that. So again, like I tie this back to what you said. It's like, it's where we have people who struggle to make the leap to say, why does this have value? And I think the other thing too you hit on was the singular use case. At the beginning of Amazon, the reason why people struggled to understand it was because all they did was buy and sell books. But no one really tried to understand why that was the case. And when Jeff Bezos explained why he only did books, one, it was from an engineering and a network analysis and the able to create the data foundation to then create the models that later have become now the algorithms and everything that power Amazon. That was the value. And so you talk about this the securest network in the world, and this is partly education for anyone listening. This is, even though you can't see it now, and maybe we're choosing just to see what we want to see, totally aware of my own human biases.
Got our blinders on.
I'm totally calling that out right now. I'm not immune to those biases, but given the data, given what we see, given what we can point to and what we've learned in history about network effect businesses, it's hard to argue against it. And sure, we may be wrong, but I think the point is too to have a disciplined process for, okay, what if we are wrong? Which is why we don't, sit there and, get people to, ape into investing in this space, even when they want to do it. Again, we have to be the ones to tell people not to do it.
Yep.
And, in fact, we've probably lost business because we've said we won't do certain things, and that's fine. We're okay with that. And then now those, the same people are going to come back and say, oh, I get why now. The same reason why people are going to go back to Jeff Bezos. Oh, I understand now why you started off with books. I understand now what you were doing before. And you can only see it when that 15-year period is gone after.
Marc, you touched on a really important point there, right? It was around the data that they were collecting, right? It's not they were selling books, but they're also analyzing consumer data and how people interacted and what they were buying, and then it's like the whole Netflix idea of like their algorithms, right? They're taking that information. I think people will agree with all of this. Like information has tremendous value now, and all that data, right? That's also what they're accumulating to then further expand their network and figure out what they wanted to market and sell next.
Yeah, and exactly. If you go back to when you go look at the first decks and the first talks that Jeff Bezos gave about Amazon, because the biggest criticism of him was that Amazon only sold books. And every single time he'd be like, yeah, but this is where I'm going.
Right.
I'm going to sell everything. And then I'm also going to make a platform for everyone else to sell everything. And nobody could make the connection. The internet was still in the early days. We still didn't have 5G. We didn't have the infrastructure there. So again, it's easy to miss, and no one should be faulted for missing it. Like I don't fault.
Yeah. And the challenge is like, how do you value that data, right? Because there's a lot of people that did this and failed. And you're right. Maybe, we're talking a lot about this, and there are businesses that tried to do this and they failed spectacularly. But we're talking about the one winner. You were talking about like some are going to fail, but there's really one massive internet winner right now, and it's Amazon.com, right? Walmart exists and does another thing. One thing I want to say is that, and we have no relationship with them at all, but one of the websites and resources that I used a lot over the last few years and still uses is A16Z, A16Z.com. They have a lot of public resources. If you are wanting to explore more around how to understand networks and how to view things that we're talking about and how to potentially value them, they've got a lot of great resources. Because cash flow and monetization of businesses, right? Looking backwards is great, and that's pretty easy to do. There's a lot of good work that's been done over the last 100 years, right? Buffett and Munger included. But looking at networks and information capture and network growth, valuations are completely different, very different, very different. And there is real value there. That's what people need to focus on.
Well, and I think, and that's okay. And I think the piece here that I like to make sure we highlight is that with new technology, again, with the internet, with data flow, with 5G, with everyone having access to the internet, and there's just new opportunities. And then this new technology and this new software is going to enable new things and ways to upgrade the systems. And that's all we're doing here. And it's not like yes, there are some cultural and inspirational pieces to new technology, decentralization, separating money from state, and self-sovereignty, and those are important things. I'm not putting anything away from that, but I think if you just step back, and it's just so much more simpler than that. It's just an upgrade of the systems, and that's okay.
Exactly. Yeah.
And that's okay. And here, the one thing I'm going to leave everyone with here before I close out with Matt is ask yourself this question, and this is what I put in my LinkedIn post. If you didn't upgrade any systems, and when I say systems, I'm talking hardware or software in your life. So you're talking computer, phone, your house, whatever.
Your car, yeah, everything.
Your car,
yeah.
Any piece of hardware you use. If you didn't upgrade them for 10 years, would you be as effective? Would you be as wealthy? Or would you be as productive if you didn't do that? And so that's the question I like to leave with. So if you can answer that and say, yes, I could be just as effective in just that, then great. I'm not going to try wasting my time trying to open your mind then to what the possibilities could be, because there are no possibilities for you. And it's going to take something else and something way deeper than me or anybody else to try to convince you or influence you to try to see the other side. And I think that's the thing. We try to convince people that don't care to be convinced or to influence. But anyway.
Mark, I real quick, just 20 seconds. I had a dear friend growing up, and I remember his dad told me one time, and he's an engineer. He's like, everything that's been invented has pretty much been invented already. And I don't see a lot of, robust growth in technology. He told me this I was a kid. This is like in the 80s. And I remember thinking, I was like, that's a weird thing to say. And I always think about that as I get older. Like, people have that mindset. I'm like, really? You think the 80s is about as far as we're going to get in terms of technology? I was blown away by it. So anyway, I just wanted to throw that out there.
Yeah, but I think it's okay. And I think the other thing I like to tell people is that we're all human, and that's a human thing, and that's okay. And I think a mistake we do is we villainize critical thinking. We villainize anybody who doesn't see the light. Like, so example, I just said, I'll ask questions, and then I can pretty much determine if they're willing to be open-minded to hear more or to learn more. And if they are, great, I'll spend some time. But if they're not, then that's more of a waste of my time and probably theirs, because we're not going to get anywhere. But I think the main thing is that person that I move on from, I'm not villainizing them. I'm not saying, you know what, you suck, you're the worst, like, you just don't see it, you should just be written off. No, I say, great, tell me what your criticisms are, and I want to take that to heart, and I want to take that from this conversation. I want to learn from this conversation. I want to learn from why I can't open your mind. And I think that's what we need more in this industry as well. Less villainizing, less combating, welcome the critical thinking. And actually, there's one person on LinkedIn that I'll say to give everyone to follow. He's a lawyer and he hates crypto. He is making his former SEC guy, John Reed Stark. So if somehow this gets back to John Reed Stark, thank you for everything you do in going against the crypto industry. Thank you. Like, I really appreciate it. We need more of you who can actually present the ideas that you present in the way that you do. We need more of it, because I think it's important, and we can't villainize those people. We need them, and we need just as much as they need people like us who can go past and see that there are benefits and there are things worth fighting for in this space. I think both sides are needed, and I'm fully willing to say that. And if anybody's listening, go follow John Reed Stark. Again, I'll disagree with some of the things that he does, but I completely agree with a lot of the things he has on a lot of the criticisms, and I agree with his approach and how he presents his arguments. And I think that's more important.
Well said, Mark.
I guess let's end off here. Matt, is there anything else that you feel like we need to get out there to end off this episode in terms of what people should be paying attention to, what you're paying attention to. This is kind of your free-form session, if you will, of the podcast.
Pay attention to the narratives, and I'm going to say it again because and we've said this on the last podcast, right? Separate the hype and the noise and the centralized, levered up institutions from the underlying technology and the potential that it has. That's what I want to leave you with.
Well said. Well, Matt, it's been fun. I think maybe we make this into a weekly thing. I think we do that. I don't know. We'll jam on that a little bit more. But thank you for coming on. Appreciate you. Again, if you want to get in touch with Matt or I, please visit our website, arbordigital.io. That's ARBORDIGITAL.io. Schedule some time with us. You can see a lot of our blogs. We write a weekly newsletter where we post our podcasts. We're also open to any feedback, to any conversations about anything you want to jam on when it comes to digital assets or crypto. So for those that are listening, thank you so much for joining us. Thank you for anyone else who's doing work in the crypto space. We need you. Please don't leave. Matt, I'm super appreciative and grateful to go on this journey with you.
Likewise, Mark.
All right, y'all. We'll see you next time on the Asset Revolution podcast. Be sure to tell somebody today that you care about them. Cheers. We appreciate you listening to this edition of the Asset Revolution podcast. I'm your host, Marc Nichols. Please don't forget to let us know how you like the show by rating and reviewing us on Apple Podcasts or wherever you like to listen. For more downloadable digital asset resources and educational opportunities, please visit us at arbordigital.io. We are here to help you get off zero safely and securely. Thanks again for tuning in, and be sure to tell someone you care about them. Cheers.
Financial advisor, unless you're under contract with or actively speaking with Arbor Capital Management or Arbor Digital, a division of Arbor Capital Management. This podcast is just that, a podcast. It is not financial, legal, or tax advice. If you have individual questions, please reach out.